Hello, everybody, and thanks for joining us for today's presentation. I'm Bill Bush, one of the advisors here at Horizon Financial Group. And over the next 45 minutes or so, we're going to talk about some of the things you need to know about starting a company retirement plan, specifically a 401k plan. Now, we're going to cover a lot of information, but first, a quick word about Horizon and a quick introduction, and then we'll get underway. So at Horizon Financial Group, we are a full-service wealth management and financial planning company servicing business leaders and owners and other individuals and families, but we also have a sizable footprint in the retirement plan space. We are the advisors on about 75 plans, most of those 401k plans located throughout the Gulf South, and most of them Louisiana-based companies. Now, I've been with Horizon for 6.5 years, and those letters you see next to my name there, those are designations specifically to do with servicing retirement plans. The CRPS is the Chartered Retirement Plan Specialist. The CPFA is the Certified Plan Fiduciary Advisory. So that's a little bit about me and Horizon. Now, let's talk 401k. So here's what we're going to cover today, 6 key things. And first of all, I'll give you a brief history of the 401k. What is it? How to get its name 401k. Secondly, we'll go over the main reasons a business owner might considering starting up a plan for his or her business. And then we'll kind of get into the nuts and bolts a bit. We'll talk about how a 401k works, salary deferrals, contribution limits, how the employer can participate. Also, the parties involved that help operate the plan, the duties of all the players, if you will. Our fourth section will discuss plan design. So there are a lot of options and features to consider when putting a plan together. And number 5, we'll take a real brief look at some of the other options or alternatives to 401k plans and the pros and cons of each. And finally, we'll do some 401k myth busting, separating 401k fact from fiction. All right, so let's start off by first taking a look at a brief history of the 401k. And to do that, we really don't have to go back all that far. 401k plans really have only been around a little more than 40 years or so. So let's go back to the height of the disco era. That's when Congress passed the Revenue Act of 1978. And that section, what it did was create Section 401k of the Internal Revenue Code. What that section did was it gave employees a tax-free way to defer compensation from bonuses or stock options. That law later went into effect in January of 1980. So in 1980, a fella, you see him on the screen there, Ted Benna, created the first 401k plan in the U.S. for his company, the Johnson Companies, and thus he's known as the father of the 401k. By the way, Time Magazine has listed that event, the 401k launching in 1980, is one of the top 80 days in U.S. history. That's some history for you. In 1981, the IRS issued some new rules which allowed employees to make contributions via payroll deductions, and the 401k began to gain momentum. Within a couple of years, nearly half of all large companies were implementing a plan or thinking about starting one. So then we fast forward to 2001, and a measure was passed that would allow for Roth contributions or after-tax contributions to be put in a 401k plan. Up until that point, only pre-tax contributions were allowed. So companies could first add that Roth option in 2006 if they elected to, but not required to. So real brief history, you think back 40 years ago, it's likely your grandparents didn't participate in a 401k. Maybe your parents did as they became more available and adopted. But historically speaking, the 401k plan itself, not very old, but has gained prominence pretty quickly. So today, the 401k plan is certainly the most prevalent and widely known of company retirement plans. Most people, even if they don't fully grasp kind of what it is, they've heard of it. And in 40 years, it's kind of known as the golden child of company retirement plans. So right now, there are 600,000 plans in the U.S. with about 60 million employees participating. At the end of the second quarter in 2021, that was $7.2 trillion were invested inside of the plans, and over 2/3 of the assets were invested in mutual funds. So again, a brief history and where we are today. But what are some of the main reasons employers adopt a 401k? What are the benefits of starting up a plan, and what are some of the considerations? Well, really, it comes down to 5 reasons. We'll break each one of these down a little bit more detail, but think number one, recruiting and retention, being competitive as an employer when it comes to employee benefits, especially in today's labor market. Then there are tax credits and tax deductions. I think we'd agree that those are both good things. And then once they are up and running, 401k plans are fairly easy to manage. And we're finding that they're more affordable now than in years past. It's not just a benefit anymore for the huge companies. And then finally, quite frankly, it's a good way for business owners to diversify away from their own company and put away more dollars for the future in a tax-deferred way. And if an owner is fully able to maximize the plan, those numbers over time can certainly become sizable. All right, well, there's no doubt we've seen a lot of flux in the job market in the past year. So how do you maintain your workforce and potentially attract new quality employees? Well, a few surveys here to point out, and they have some pretty big numbers. In a recent PricewaterhouseCoopers survey, 65% of employed workers said they are now looking for new jobs. This was actually back in August of 2021. A bank rate survey at the same time showed 55% of workers either employed or actively looking now are likely to be searching for a new job in the next 12 months. And those numbers may seem high, and your industry certainly may look different, but offering a 401k plan, especially one with a competitive match for the particular field you're in, may be a way to keep current employees engaged and productive, as well as a way to recruit some of that outside talent. So when people are searching for jobs, what are they really looking for? Why are people actively searching for new opportunities? Well, this PricewaterhouseCoopers survey from earlier states that employee benefits are cited as the number 2 reason, and inside of that, the 401k is the second benefit cited, right behind health insurance. So right behind salary and wages, you get employee benefits and ahead of career advancements. And so benefits, of course, including a 401k, a better way to save and secure a future and a dignified retirement. Those things matter to those out there searching. So think if you had that 401k option included in your employee benefits package, would it matter? If all other things were equal, would having a 401k make you more competitive for the top talent? Would it be something that would keep your current employees in place? And would it be a reason for the right employees to choose working for you, maybe rather than the competitor down the street? So when we talk about the history of 401k, we mentioned a number of workers, currently covered by a plan, some 60 million. Here's a percentage of all the workforce covered by all company retirement plans. A little less than 70% of all workers covered by some sort of plan in the US. And when you just look at full-time workers, that number jumps to almost 80%. That's the second line there. That's including all types of retirement plans, though, including pensions and defined benefit plans, et cetera. But about 60% of full-time workers are covered by defined contribution plans, which is what a 401k is, a defined contribution plan. And those numbers are growing. So to be competitive with what the rest of the marketplace is doing, it makes sense certainly to look at it. And most workers these days, expect some sort of offering. Many of them tie it to the quality perception of the company they're looking at. So let's talk tax credits now for the employer, the sponsor of the plan. There are tax incentives, and they come in a couple of forms. The first is tax credits for starting up a plan. And really, thanks to the Secure Act that was passed a couple of years ago, these are getting more generous, or they are more generous now. The credit is, and I'll walk you through this, but it's 50% of your eligible startup costs up to the greater of $500 or the lesser of $250 multiplied times the number of non-highly compensated employees who are eligible to participate in the plan. That's a mouthful, or $5,000. So boiling that down, another way to look at it is the tax credits are going to be as little as $500 or as much as $5,000. So the eligible startup costs, you can claim that credit for ordinary and necessary costs to set up and administer the plan, educate your employees about the plan. There is another $500 additional tax credit for auto enrollment plans. So over 3 years, that could be $1,500, and that's on top of the other credits we already mentioned. And so the eligible tax years that you can claim this credit, you can actually claim the credit for the first 3 years of the plan, and you can actually start claiming that credit in the tax year before the tax year in which the plan became effective. So over that 3-year period, potential credits for starting a plan or as much as $16,500. Not too bad. And then there are tax deductions. And these are every year the plan is in existence. An employer contribution, so any employer contribution to the plan, they are deductible, and the deductions do have limits. You see them here. The deduction for contributions to a defined contribution plan cannot be more than 25% of the compensation paid during the year to your eligible employees that are in the plan. But remember those two tax pieces. So the annual employer contributions deductible, and then the startup tax credits available for the first 3 years. Another reason to consider is that setting up and maintaining a plan, it may be easier and more affordable than you think. And, certainly the trend in what we found in the trend in the industry in the past couple of years has seen that startup costs really going down, and kind of the emergence of different providers who've launched low-cost startup plans and even specialize in that. So we mentioned the tax credits you see and that are now available. That helps. But there's also this automation and payroll integration that have really taken some of the tedious work out of day-to-day operations of maintaining a plan. And then with providers implementing technology inside their platforms, we're seeing that it's easier for employers to keep track of everything, keep track of the plan, and have all the tools that they need at their fingertips. Then finally, I think a good point is if you're engaging with consultants who know, work, and have experience in 401k plans, you're going to be working with professionals that can help you navigate through any stumbling blocks you might come across. Those folks have seen a lot. And for advisors, look for special designations related to company retirement plans. Ask advisors and TPAs, third-party administrators, how many plans do they service? What's their experience level? Because experienced specialists, on your side, that'll help things certainly go a lot more smoothly. And then the final reason to start up a plan, if you're a business owner, is your own savings. It's a good way to put away tax dollars that will grow tax deferred. And we'll talk about some of the contribution limits in a bit. But, the limits inside a 401k plan, they're much higher than if you just had an IRA on your own. And, over time, that difference can be significant. Also, it gives you just another bucket of assets to access once you reach retirement. And many owners, we come across have a lot of capital and equity tied up in their business. And some will say, well, my business is my retirement plan. But what if it takes longer than expected to sell it or unwind out of that situation? What if you're not able to get, what you thought it was worth? It makes sense to be putting away money in other areas that you can access. And that, in my mind, makes a 401k a smart piece of the overall retirement plan puzzle. So there are some good arguments for establishing a plan, but let's shift gears now and answer this question. How does a 401k even work? As you can imagine, there are a few key pieces and moving parts to having a plan run smoothly. So what is a 401k? Remember our history lesson. It's part of the tax code, but here's how the IRS defines it on their website. So this is straight from the tax horse's mouth, if you will. A 401k is a feature of a qualified profit sharing plan that allows employees to contribute a portion of their wages to individual accounts. Elective salary deferrals are excluded from the employee's taxable income, except for the Roth. And employers can contribute to the employee's accounts. Distributions, including earnings, are includable in taxable income at retirement, with the exception of the Roth. That's what the IRS says. That's how they define it. So who can have a 401k? You might be wondering, does your company have to be a certain size to offer a 401k? The answer is no. Just about any type of company out there can establish a 401k. Anything from a sole proprietor, LLCs, S Corps, C Corps, any size, any industry, even nonprofit companies can actually offer a 401k. In fact, there are very few types of companies that can't have a 401k plan. Those would include some sorts of state and local governments and their own entities, they have their own types of plans for their employees. So again, most companies are eligible to start a plan, no matter the shape, size, and industry. So our IRS definition, a couple slides back, mentioned elective salary deferrals and the fact employers can contribute to the accounts as well. So we're going to break down the contribution types real quickly and then talk about the limits involved. Employees make contributions through salary deferrals. What they're doing is they're directing a portion of their earnings to be deposited into their account. Now, notice the term salary deferrals. We're talking about future earned income that they are electing to put in the plan. Every once in a while, we do get this question from employees. Hey, I got 20 grand in a checking account. Can I just write a check and, deposit that in my 401k? The answer is no, you can't. Employee contributions are salary deferrals made through payroll deductions. So employees over age 50, they actually have what's called catch-up contributions as well. We'll talk about that in a bit. As far as the employer is concerned, here are some of the ways they may make contributions. They don't have to make all of these, but here are some of the ways they can. Matching contributions, simply matching what the employee is putting in there up to a certain percentage. There are profit sharing contributions, a non-elective contribution. That means that the employee doesn't have to put any of their own dollars in to get this employer contribution. And then there are safe harbor contributions. We're going to dive into that in just a little bit. There are a couple of types of those, but we'll be explaining that in just a bit. So now let's talk more about the employee's contribution. Now, as we talked about, these are from salary deferrals. So when they enroll, they're making a contribution election, and they state that as a percentage or a dollar amount that they want withheld from their check and directed into the plan. They can make a traditional, what's called the pre-tax contribution. It's lowering their taxable income for the year, or they can have an after-tax Roth contribution. So that's if the plan allows it. You can add the Roth election in there. By the way, the plan certainly not required to do a Roth option, but most 401k plans do have that now. They do offer that. If the plan does have a Roth, the employee can actually contribute to both the pre-tax and the Roth if they want. But here's what they can't do. They can't go over the annual limit, no matter what the source. And those limits are set by the IRS. Near the end of each year, they'll announce what the limits are for the upcoming year. And usually these limits are increased every couple of years. So for 2022, the annual contribution limit you see there is $20,500. That's the maximum an employee could contribute from their salary into the plan. Now, note the max is not a percentage, it's a hard dollar limit. And so to be clear, to contribute the full $20,500 for the year, the employee must have earned at least that amount or more for the year. So for those earning less than that $20,500, their limit is capped by 100% of the compensation. So you look in the middle, you see, but wait, hold on. For participants who turn 50 years or older, they can make catch-up contributions. So for 2022, that means anyone 50 or older can put an additional $6,500 into the plan. Then when you add that on top of the regular limit with the catch-up, anyone 50 and older could contribute a total of $27,000 into their 401k plan this year, again, provided they've earned that much or more. And by the way, that catch-up provision is available starting the year an employee turns 50. So even if their birthday is in December, they can actually contribute that catch-up contribution that year. But 50 plus or not, you'll notice these contributions, these limits here are much higher than what you could do in an IRA. Those limits for 2022 in IRA are $6,000 with the catch-up contribution of $1,000 for 50 plus. Now, a few more details about employer contribution types. So first of all, an employer can make matching contributions, and it can be stated in what's called the plan document or the adoption agreement in one of two ways. The match can be specifically spelled out. It could say something like this, the employer will make a matching contribution in the amount of 50% of the participant's contribution up to 6% of his or her salary. So how would that work? Well, if an employee made a 6% contribution, the employer is matching 50% or half of that. So the employer would then put 3% in there, in that case, in that match. Or the second option here, they could state in the plan that the employer is going to make a discretionary matching contribution. That means it's up to the employer's discretion each year on how they will match the participants' contributions, if at all. Yeah, that's right. The employer contribution is not required. You don't have to make one, but certainly by far, most plans do. And most employers make matching contributions throughout the year. They spread that out, but they really actually could wait and make that matching contribution before their tax deadline if they elected in kind of a lump sum. Just to let you know. Second thing there is the profit sharing contribution. This is usually a discretionary, which again, they don't have to do it. It's not required. We see employers here kind of usually funding this one right before their tax deadline, deciding if they could even do one at all. And even though it's called a profit share, the company does not have to have profits in the year it's funded. So you have to have the cash to fund it, but you certainly don't have to have profits. And finally, there are safe harbor contributions, and there are two types of those. There's a non-elective safe harbor, and that's where the employer gives every eligible employee 3% of their salary, whether the employee elects to put any dollars of their own in or not. It's non-elective on the participant side. So they get it whether they put in dime in or not. And the second way is a matching safe harbor contribution. So the employer here is matching what the employee puts in. And there's two ways to do that. The first is matching 100% up to 4% of salary. So if the employee does 4, the employer is putting in 4. If they do less than that, if they did 2, the employer is only going to do 2. They're matching 100% capped at the 4%. The other matching safe harbor contribution we see is we're matching 100% up to 3 and then 50% on the next 2% the employee puts in. So in order to max that one out, you'd have to put in 5% as an employee to get the 4% from the employer. Those are the safe harbor contributions. So overall, now we're talking about overall contribution limits. So we have the employee contribution limits we talked about. Remember the $20,500, but the IRS also sets the overall limits on plans, and these kind of called the annual additions, if you will. So if you take the employee contributions, add the employer matching contributions, the other sources, the non-electives, et cetera, and then anything what's called forfeitures, that the absolute total that could go in a participant's account for 2022 is $61,000, adding up all the sources. That, however, does not include anyone that's over 50 that can do the catch-up contributions. That's the additional $6,500. So for folks 50 and older, the limit for 2022 is actually $67,500, as mentioned before, as long as the employee has earned that amount. So business owners looking to defer taxes and save, these higher limits look attractive, right? But as we'll see, the government doesn't make it as easy as maxing out all that every year. Before we get into that, though, first some annual requirements, some info on that you have to do. If you have a 401k plan, you got to file what's called a 5500 with the IRS on the plan each year. Small plans can file what's called a short form. There are various notices that the participants are required to receive, so responsible for that. And then for plans that kind of have over 100 employees, there's an annual audit requirement just to make sure the plan is running as it should be and procedures are followed properly. And of course, outside partners will certainly assist with those duties. And then as well as the last item on the screen, there is non-discrimination testing. Non-discrimination testing. Because of the tax benefits involved, the government requires the plan to test each year to make sure that the plan doesn't overly favor the owners and other highly paid employees. So to do that, eligible employees are divided into two groups. You see them here, HCEs, which are called highly compensated employees, and non-HCEs. The HCEs are made up of any 5% owner or more, no matter how much compensation they received, as well as any direct family relatives that might be in the plan, plus any non-owners who make compensation of over $135,000 in compensation. Those are defined as your HCEs, your highly compensated employees. The non-HCEs, that's pretty much everybody else in the plan. So the plan cannot disproportionately benefit the HCEs when you compare it with the non-highly comped employees. And so for the purpose of today's presentation, that's getting into the weeds a little bit. So we're not going to go deep into this, but it is important to know of these limitations. Basically, two tests are performed. They're called the average deferral percentage test, the ADP, and the ACP, which is the actual contribution percentage test. And the ADP just compares the percentage that the non-highly comped are contributing compared to what the HCEs are contributing. The ACP does a similar comparison, but adding in the employer matching contribution, et cetera. So the formulas, show here that really the results of the NCHE, how much they're putting in, the non-highly comp, dictate how much the highly comp group can contribute. A lot of numbers here, but just know that if the plan fails these tests, there are a couple of remedies. One of them is that at the end of the year, the HCEs may have to get some of their contributions kicked back and refunded. The other fix is the company could put in non-elective contributions to all the non-HCEs so that the plan is then in compliance. Not really fun to go back at the end of the year and tell your highly comped employees that they're getting money back. But hold on, remember the term safe harbor contributions. That can come to the rescue and certainly comes into play. And let's talk about that. So by making safe harbor contributions, the plan can avoid some of that testing, the ADP, ACP testing. And there are the three safe harbor formulas that we talked about. The non-elective, hey, we're giving everybody 3%, whether they put any of their own dollars in or not. Then there's the match, the basic safe harbor match, 100% of the first three and then 50% of the next two. Then the enhanced, we're doing 100% of the first 4% of each employee's contributions. A few options there to set up a safe harbor plan, but a couple of things about safe harbor contributions. Employees are immediately vested in safe harbor contributions. Investing means ownership. So if the employee left, they would be able to take not only what they put into the plan, but any safe harbor contributions they would take with them because they would be 100% vested in them. HCEs, however, if you do a safe harbor plan, has the ability to max out their contribution without having those refunds and failed testing at the end of the year. So building a 401k with a safe harbor match or non-elective contribution, those features are actually part of the plan design. And there are certain features when designing a plan that you have control over as a business owner, and you can help make it work for your situation. So when it comes to plan design, there are certainly a lot of levers you can pull. The plan document or the adoption agreement can be 30 or 40 pages. This makes, with all these options, it makes each plan really unique. So somebody coming from an outside 401k plan into another may not have the same features. But here are some of those things to consider when setting up a plan. What is the eligibility going to be? When can employees enter? Are we going to have the Roth option? How often will employees be allowed to change their contribution, et cetera? What are we going to match? Are we going to do a safe harbor? Is there going to be a profit sharing? What's our vesting schedule going to be on any of those discretionary or matching contributions? Are we going to allow loans and hardships? The QDIA here is the qualified default investment, meaning if a participant enrolls and doesn't elect an investment, they would automatically be put in this default investment by plan design. And then there's also features like auto enrollment and then other after-tax contributions. Again, a lot of levers in setting up the plan. These are just some of those things that are up to you when you set up a plan. One of the first things to consider is how do you want to handle eligibility? And for many years, it was kind of standard to, you see it at the top, the 1 year wait, 21 years of age with entry dates, 2 entry dates throughout the year. We still see this January 1st and July 1st. That was kind of the default. And I think a lot of employers felt like, well, hey, I want to make sure the employees are committed and are going to stick around before I offer, before they can participate in a 401k. What we've seen in recent years as some employers kind of relaxing off of that a bit. And that is simply to be more competitive with recruiting, and be more competitive with benefits. All things equal, would a prospective employee want to sit out a year or more? Think about that. So if somebody was hired today, February 10th, and they became eligible after a year, that would be February 10th of 2023. And then the next entry point would be July. Well, that's somebody being hired today, almost waiting a year and a half to be able to start participating in the plan. So below, you see some examples of how eligibility can be handled. We see some companies say, well, let's just make them eligible after they've been with the company for 90 days. Or maybe we make everybody immediately eligible and they can enter the plan the next month after they've been here. Or immediate eligible, we've seen this in some plans. Hey, they're immediately eligible to put in their own dollars in the plan, but they're going to do a 1-year wait on employer contributions. And then the age piece, we've seen that on some industries, go down to just an 18 years of age requirement. So flexibility there in plan design. Here are some of the design features and how prominent they are and how often they're used in 401k plans. So the Roth option, we see that pretty much it's growing. It's over 70% of the plans offer that Roth option now. Most are doing that. Remember, that's only been available since 2006. A lot of young folks are asking about Roth, right? Because of payroll integration, we're seeing most plans allow the employees to change their contributions at any time during the year. That used to be kind of limited, maybe 2 to 4 times a year, quarterly, if you will. That does vary. 60% of plans are safe harbor plans. Remember, that helps with the testing. 72% offering loans, a little bit more offering hardship distributions. Auto enrollment, we're seeing an increase in that. And I think that's due to the Secure Act and adding some of those tax credits we talked about. The most common vesting schedule on some of the discretionary employer contributions and the matching is the 6-year vested schedule. And what that basically is okay, after the employee's been there 2 years, they're vested in 20% of what the employer matches, all the way up to 6 years, they're 100% vested in that. So those are just some of the trends, but remember that flexibility and how you want to set up your own plan. So how does it all work? Let's take a look at all the moving pieces, all the parties that play a role in a 401k plan. Of course, at the heart of every 401k plan is the employer. That's who decides to sponsor the plan and make it available. So the plan sponsor is really the ultimate fiduciary of the plan, meaning they have the duty to make sure that the plan runs for the benefit of the participants and the beneficiaries. So the employer obviously helps with the payroll deduction side, make sure that goes in, tracks eligibility, decides on that plan design we talked about. They're required to file the forms. They keep the plan kind of smoothly going in compliance with regulations. They can get help with that. We'll talk about that in a second. The employees, of course, are the participants in the plan. They are making contributions to the plan via those salary deferrals. And of course, they have to enroll timely, and they are responsible, by the way, in most cases, of making their own investment selections and making changes to either their contributions or their investments. But next, we get into parties who receive compensation for the roles they play. And we're going to start with the record keeper. So the record keeper's job is to track assets. You see it in participant accounts. They have the online access and lets participants know what they invested in, what they've earned. And they track all that by all the sources. So employer and employee contributions. They provide the online access, as I said. In what's called a bundled plan, the record keeper, they also perform administrative duties. And we'll have more on that in a second. But some record keepers, duties include, maintaining the website, as we mentioned, printing and sending out statements to employees, providing retirement calculators and guidance with other financial wellness type things, producing, the enrollment and education materials, and offering a toll-free number that the participants can call in and get assistance with. So there are many record keepers out there. Here's a look at a few of them you might recognize: Nationwide, Principal, Transamerica, John Hancock, Fidelity, American Funds, the Standard, Empower. These are just a few. There are many more. And there are even some payroll providers that provide 401k record keeping services. You see ADP and Paychex here. There are also many payroll providers that don't offer 401k record keeping services themselves, but integrate with other record keepers, companies like Paycor, NetChecks, Spectrum, APS, to name a few. And payroll integration, as we mentioned earlier, that's kind of becoming a bigger factor, right? That integration piece when setting up a 401k plan. All right, next up, we're going to talk about the third-party administrator, the TPA. So in what's called an unbundled plan, the TPA performs a lot of these administration duties of the plan, processing enrollments, account changes, loans, and distributions. They perform the non-discrimination testing. They draw up the plan document and kind of update that plan document. They're that plan document steward, and they assist with, or they file the 5500s. That's the TPA. Next up are the actual investments in the plan. By far, as we mentioned, most plans use the mutual funds in their lineup, and a mutual fund is just a company that pools money and invests in a basket of stocks, bonds, and cash equivalents in various shapes and sizes. Each mutual fund has an expense ratio or fee that the investor pays. And here on your screen, you see some mutual fund companies that offer investments in 401k plans. Again, many, many others, but these are some you might be familiar with. And finally, we have the financial advisor. The advisor does many things, including participant education, enrollment meetings, account and investment reviews. They plan, they do the plan's investment monitoring. They can act as what's called a 321 fiduciary or a 338, where they are making investment changes and recommendations in the plan. And they can also assist with RFPs or vendor searches, looking for record keepers and other pieces that might be a good fit. So that's kind of all the parties that are involved in the workings of a 401k. Now we're going to look and compare at how 401k plans kind of compare with what else is out there. Is a 401k plan right for you compared to what else? So let's take a look at a few of those alternatives, and we'll start with the simple IRA. So the simple IRA is for small companies of 100 or less employees. It does have lower contribution limits when compared to the 401k. Remember the 20,500? Well, simple IRAs are only 14,000. The 50 plus catch up smaller as well. Simple IRAs, only pre-tax contributions, no Roth options. The employer has to make contributions in a simple IRA, whereas it can be discretionary in a 401k. So they can either do a matching or a non-elective, you see there. The employee is 100% vested in all contributions. There is no loan feature, and employees can take distributions at any time, but those are subject to taxes and penalties, some of them pretty severe. And the eligibility is not that strict. This is the strictest it can be, by the way. The employee has earned $5,000 in the last 2 years and will reasonably make that much in the next year. Many plans that are set up on simple IRAs are even less restrictive, like, okay, well, you can start, this year without any pay requirement or whatever. These are easy to set up, and there is no annual filing required for a simple IRA, unlike the 401k where you had that 5,500. Next up, you see the SEP, what's called a SEP IRA. Here's some of the main features. An employer with 0 or more employees. That means obviously a business owner could have an employer only plan. And this is, by the way, employer only contributions. Employees don't contribute in a SEP IRA. The employer can decide whether to make those contributions or not, kind of the discretionary thing, right? There is a limit, 25% of the employee's compensation. No Roth option as well in a SEP. Employee, kind of like the simple, 100% vested, no loans. Employees can take the distributions. The eligibility is a little different, 21 years and up, and with a small salary requirement you see there. Again, no annual filing and easy setup. For the business owner, that's a single business owner with no employees, there is what's called the solo 401k. It is for just as I said, a small business owner with no employees. However, the spouse actually can participate. Same contribution limits as a 401k. You can have the Roth option here, and you can make that employer, because remember, in a solo, you're the employee and the employer. You can make the contribution as the employer up to 25% of compensation. Filing on a 5,500 is not required till that plan reaches a certain asset size. It's 250,000. But if any other employee is hired, you have to terminate the plan. It's meant for one person, and in some cases, the spouse. Other things you may be familiar with or heard of, 403B plans do share a lot of characteristics kind of with 401ks, but they're made for public schools, employees of certain nonprofits, churches, clergy, that kind of thing, education. Cash balance plan, that's a type of a defined benefit plan, whereas a 401k we talked about, it's a defined contribution plan. Those cash balance plans are targeting a certain promised benefit per the employee at retirement. So an actuary has to be involved in that. And in a cash balance plan, each participant has what's called a hypothetical account, and each year they're credited with a pay credit, which is a percentage of the compensation, and then an interest credit targeting a set amount of growth. And the employer bears all the investment risk in those type of plans. They are typically funded only by the employer. But a company can have a cash balance and a 401k plan. They can have them at the same time. That non-qualified deferred comp plan, see this from time to time. It actually differs from a 401k plan in that it is offered only to a small section of employees, typically the upper management, whereas a 401k plan, remember, can't unfairly discriminate. Well, a non-qualified plan, by definition, actually must discriminate because it's only offered to a small percentage of employees. If you've heard the term golden handcuff plan or SERP, supplemental executive retirement plan, those are non-qualified deferred comp plans, and those type of plans actually can also be offered in addition to a 401k. So maybe you've considered starting a 401k company at your company, but you heard a lot of noise out there, and there is a lot, and you maybe you've heard, well, why would you want to pull a trigger on something like that? So now what we're going to do is separate fact from fiction as we do a little 401k myth busting. So some businesses are too small to have a 401k plan. Myth number one. Well, we just talked about this. No business is too small to have a 401k plan. In fact, the sole proprietor can have a 401k, that solo 401k. Companies of all sizes, from the self-employed to businesses of many, many thousands, have 401ks to get ready for retirement. So we are busting that myth. That's right. Myth number one is busted. Myth two, 401ks are too complicated to set up and maintain. Well, I think the answer here is, again, look to specialists. So record keepers, advisors, TPAs, those other pieces of the pie we talked about, are there to help with that integration. We have payroll providers, support with compliance testing and support with filling out those required forms. Reporting functionality available with the record keeper and monitoring the employees and how they're using and saving with the plan. And then that education piece and investment monitoring, which advisors do a good job of doing. So we're going to bust this. They're not that complicated as long as you can rely on to some good providers. Myth number three, 401ks require an employer match, and I can't afford that. Well, 401k plans do not require a match. A match may be discretionary, right? You can do one year and not do one the next. But we do find, however, participation is greater in plans that do offer a match. And, this is another thing to keep in mind, that the employee deferral limits are higher in a 401k than an IRA. So you can give, by offering a 401k, you can give your employees a higher threshold of savings to aim for rather than what they can do in just an IRA. And then if you're worried about, the in and out, somebody works just a couple of years and they're taking the match, remember those vesting schedules. If turnover is an issue, you can set up a 6-year vesting schedule on those employer matches. So, those are just a few things to think about. Let's bust that one. It's busted. All right. My employees won't take advantage of a 401k. I do think, that maybe this varies from industry to industry, but the 401k, what we found in some recent studies we talked about is that it's the second most requested benefit right behind health insurance. 40% of employees working for small businesses say they would actually leave their current company for another one that offers a 401k plan. That's pretty sizable. And then 90% of employees, the young ones especially, prefer benefits over a raise. Busted. Myth number 5, I would have to take on too many risks and responsibilities to offer a 401k plan. Well, it is true. It is a fiduciary responsibility to offer a plan, but certain fiduciary responsibilities can actually be shared or outsourced. You can never, totally rid yourself of a fiduciary duty, but there are providers to help. And you don't need to be an investment expert. Advisors can sign on and to be that investment fiduciary we talked about, as well as the administrative side. Investment fiduciaries are available there as well. So that one, busted. Having a 401k plan is expensive. Okay, we talked about this. Certainly a lot of low-cost providers and fund options are available, seeing those becoming, more prevalent as lots more companies really establish these plans to be competitive. Costs can also be certain costs shared and picked up by participants. Startup and tax credits and tax deductions. We talked about that a lot. They're available. And so that helps on the expense side. So that's busted. Couple more, and then we'll move on. My plan, tax benefits, they're not that great for business owners. Plan tax benefits are not that great. Well, those startup credits are certainly real and available for 3 years. And then there's the ongoing deductions as business expenses for those employer contributions. And then there's that owner side of things, right? If the owner's contributing, there are tax savings to be had there just by contributing. So busted on that one. Final myth, small business owners don't need a 401k. My business is my retirement plan. And while it is true you've put a lot into your business, this was something I came across from the U.S. Small Business Administration Association, that business owners over the age of 50 are less likely to have well-funded retirement funds than their employees, which is kind of shocking, and the reason is obviously that business owners put a lot into their businesses, but other sources, may not be enough. IRAs, if you're a business owner, you might not even be able to do that and take the tax deduction, right? So, a 401k plan makes sense to be another bucket to access when you get to retirement. We're busting that. Okay, so a lot discussed here today, but what did we do? Well, we started by talking with a little 401k history. You met the father of the 401k, Ted Benna, by the way. We looked at reasons why business owners like yourself might be interested in starting 401ks. We showed you how the 401k works. We looked at the contribution sources. We looked at options and what's available when it comes to plan design. We presented how other company retirement plans stack up against the 401k option. And finally, we did some myth busting. So that's what we covered. Just remember, we're here to help you and be a resource for you. If you would like to sit down with us at Horizon and have a conversation to see if a 401k plan is right for your company, we'd be glad to do that. Just reach out to us at info@HorizonFG, or you can actually go to our website, www.horizonfg.com. There is a connect button at the top of the page, or you can hit the start a conversation button found on the bottom of the page. Either way is fine to reach out with us at our website, www.horizonfg.com. All right. If you have any questions, please forward them to our email, info@horizonfg.com. I think we went a little over time than we were planned on going, about 45 minutes. So we certainly hope that this was informative to you and helps you in any way, and it was valuable, and we appreciate your time. And so be glad to answer any questions. Just drop us that email at info@horizonfg.com. And finally, we'd like to invite you to check out our 401k podcast. My brother Andy and I do this. It's called Inside the Plan with the 401k Brothers. It's dedicated to tips and education pieces for participants and even plan sponsors. And we cover a lot of topics related to saving for retirement. So check us out. You can scan the QR code there. You can go to Libsyn or Apple Podcasts and just search Inside the Plan with the 401k Brothers and check us out there. Again, we thank you for joining us. That's going to wrap up our presentation. Feel free to reach out to us in any way if we can help you. And you see our number on the screen there, 225-612-3820, if you just want to call us rather than email us. That's going to do it. Thanks for joining us. We'll see you. Bye.